Hello everyone, welcome to another RF crypto video. Today's markets, they've gone up by 1.5% and the global crypto market cap stands at 2.15 trillion. It's not a big increase, but any increase is welcome. Bitcoin is up by 0.93%, almost a percentage point. Ethereum obviously overreacts, as I always say, because the global crypto market cap is up by 1.46%, while Ethereum price is up by almost 2.5%. Terra is at its all-time high at almost $103, and it saw a 7.76% increase in the last 24 hours. And I'll speak about Terra in just a little bit, but moving on, most of the cryptocurrencies have gone up. Obviously, there are some cryptocurrencies that have gone down. We see some reds here, and as I said before, there is decoupling going on, whereby most of the cryptos are becoming more and more uncorrelated with Bitcoin, which means that they have their own specific factors that cause the movement of their prices to take place independently of which direction Bitcoin goes. So Bitcoin might go up and those cryptocurrencies might go down because of their own token specific factors. Looking at the Bitcoin charts, we see that it is flirting with the $47,000 support level. We saw 3 successive green candles, which usually means that a breakout is incoming. But then the sellers came into play and they sold a bunch of their Bitcoin, which caused the price of Bitcoin to quickly go down and test the $47,000 support level. Once it touched this, we saw another buy up. And now it's standing at $47,400. So it is flirting with the $47,000 support level, and I think it will trade laterally if there's no significant news in the market. If there is positive news, it might go up and touch the $50,000 level. If there's very, very bad news, then it might go below this support level. It will break the support level and go down and test the $45,000 level. But for now, I think the trajectory of Bitcoin is lateral. Moving on to some news. US lawmakers introduced e-cash bill and a new push to create a digital dollar. So these representatives have introduced the Electronic Currency and Secure Hardware Act to direct the Treasury Secretary to develop and issue an electronic version of the US dollar, with an eye to preserving privacy and anonymity in transactions. So just remember that this is just an act. It still has to go through Senate, Congress in order to become an actual law. So it's just a suggestion that these representatives have made, and it makes sense because the whole point of cryptocurrency is to preserve privacy and anonymity, but at the same time it has to be regulated. So the electronic dollar would be a bearer instrument that people could hold on their phone or card. The system would be token based and not account based, so it will just be exactly the same as, for example, holding Bitcoin tokens in your wallet, but in this case you would hold a digital dollar in your wallet. So if someone were to lose their phone or card, they would lose access to their wallets and they would lose their funds. It will be like losing an actual wallet with dollar bills in it. The electronic dollar would be deemed legal tender and be functionally identical to a physical greenback. So they would be pegged in a 1-to-1 ratio. So this form of e-cash would support peer-to-peer transactions, and it will fully support anonymous transactions. And this is very important because there has been some concern of eroding privacy in this industry because of centralization and reporting standards, but this bill proposes anonymity, but obviously it's anonymity provided that they're not engaged in any illicit activity. So under these proposals, users wouldn't be subject to any more severe KYC rules than anyone trying to use cash. They would have to acquire the e-cash dollars via bank accounts, peer-to-peer transactions, or a store, but then could do whatever they liked with it. So because they have to go through a bank, or they have to do a peer-to-peer transaction, or they have to go through a store, all of those transactions will be recorded, and because the wallet is linked to an individual, probably through a social security number or any form of identification that they use in the US in a state basis or at a federal level, then you wouldn't need to submit a lot of documents for KYC because your information will already be available through that identification number. And this system is also being used to serve people who are unable to hold bank accounts because of minimum balance requirements. A lot of people can't afford to open bank accounts because they set a minimum account balance that you have to maintain, and if it goes below that, they just close the account. or those who don't trust banks because banks may charge fees or freeze funds. Because banks have so much power, a lot of people don't trust them, so they just stay unbanked and primarily deal in cash. But with a digital dollar coming along, being a cryptocurrency, it gives people more peace of mind that they have more control over their funds. Relating to the previous article, Joe Biden eyes $5 billion in 2023 revenue from applying new tax reporting rules to cryptocurrencies. So, the President of the United States submitted his budget proposal for the 2023 fiscal year in conjunction with the US Treasury Department. So, they estimate that they can gather roughly $11 billion in revenue over 10 years and nearly $5 billion in the next year alone. And this would be done by modernizing rules to apply certain financial accounting and reporting practices to digital assets. Exactly what they mean by this gibberish is basically that they want to implement regulation in order to be able to tax individuals dealing in cryptocurrencies. The Biden administration projects $6.6 billion in revenue between 2023 and 2032 tax years from applying mark-to-market rules to actively traded cryptocurrencies. And this is where it gets really, really confusing. They're trying to screw the citizens over, I suppose, because mark-to-market basically means that they're going to tax unrealized gains. Meaning that if you bought one Ethereum at $3,000 and that Ethereum goes up to $4,000, even if you don't sell the Ethereum, you will still be taxed on it. And that's very, very wrong, because imagine that the price goes from $3,000 to $4,000, you get taxed on that $1,000 profit, but in the next 2 weeks after you get taxed, the price goes down from $4,000 to $2,600. Now you cannot offset those losses against your taxable income. So you've already lost money through the taxation of unrealized gains, and now you're still losing more money through the decrease in the price of Ethereum. And I think this is just a way of them raising funds, and mark-to-market never makes sense. You should only be taxed when you sell your assets. Not only do they want to raise revenues through taxing crypto directly, but they want to raise revenue by taxing crypto indirectly. So the United States seeks to increase revenue by requiring US residents to report any holdings in offshore accounts above $50,000. So they basically say that the global nature of the digital asset market offers opportunities for US taxpayers to conceal assets and taxable income by using offshore digital asset exchanges and wallet providers. So if people try and use offshore accounts to trade in crypto, they're going to try and force those exchanges or the banks that they're dealing in crypto in offshore jurisdictions to report to the US of their citizens' offshore holdings in order to tax them. And they think they can collect $2.2 billion over 10 years by tightening this reporting requirement. It's all about increasing vigilance. It's all about a bigger eye, not only in the US, but in offshore jurisdictions and overseas as well. So they're basically defending the increase in the reporting requirements because they say that digital assets can be used for tax evasion. So third-party information reporting is critical to identify taxpayer and bolster voluntary tax compliance. So I suppose they're scared of tax evasion and money laundering. That's why they're implementing these rules. But the reality is basically that they want to increase revenue. And at this stage, the budget is just a proposal for changes that would go into effect on January 1st, 2023. So this kind of gives us an indication that the crypto regulation framework will be ready by then and will be implemented by then. And that's why Joe Biden in the last few weeks has pushed for the government departments such as the Treasury to come up with a regulatory framework for cryptocurrencies and digital assets. And one of those ways was to issue an executive order for that purpose. Moving on, institutional crypto funds see largest capital inflows for 3 months. Investment products for digital assets saw total inflows of $193 million last week, a level not seen since early December 2021. And remember, this was a time when crypto was rallying. We were in a bull run. Prices reached about, let's say, $68, $69, $70,000 almost. And the fund flows had a big focus on Bitcoin, with over 50% of the capital going into products based on Bitcoin. And this is no coincidence because we have seen the price of Bitcoin rising very, very rapidly. If we look back here, it went from about 41,000 to 47,000 in less than 2 weeks. Solana was a runner-up, seeing $87 million in inflows for the week. And Solana-based funds now represent 36% of assets under management with institutional firms. Compared to the 87 million that Solana brought in, Ethereum-based funds only saw inflows of $10.2 million. And this is of paramount importance because it just tells you that Solana, with its scalability, low transaction fees, fast processing times, is being seen as a potential replacement and actively being used as a replacement of Ethereum, because more and more projects are being built in Solana. A lot of more money is being flowed into Solana compared to Ethereum, which is slow, clunky, and expensive. But let's see if Ethereum 2.0, which is due to come out soon, by soon I mean in the last 2 years, let's see if it changes anything. And most of the inflows into cryptocurrencies came from Europe, with 76% of inflows coming from the continent. And this was following the news that a bill proposed to ban proof-of-work mining did not pass. So proof-of-work mining is basically using computational powers to solve complex mathematical issues in order to mine cryptocurrencies such as Bitcoin. And because this bill didn't go through, it gave firms and individuals sort of a new confidence in cryptocurrencies, and that's why they're pouring money in. Terra's coin Luna set new highs of nearly $106. Prices have increased by nearly 10% in the last 24 hours. And I just wanted to briefly speak about this because the Terra network is a framework that allows developers to create custom blockchains and build their own decentralized applications on top of Terra for various use cases. And this is quite a complex and very important network because it allows developers to create their own blockchain. They can have their own network within a network. And this has significantly changed the way people interact in crypto. So the reason why the prices have risen to all-time highs is because the sentiment for Luna has grown in the past month, largely due to the Luna Foundation Guard, a Singapore-based nonprofit that is purchasing over $3 billion worth of Bitcoin as an additional layer of security for UST, which is Terra's decentralized dollar-pegged stablecoin. So Do Kwon, the founder of Terra, has said that they want to buy up to $10 billion worth of Bitcoin in order to back UST. So Bitcoin is now used as a reserve currency for UST. And because of this significantly good news, Luna shot up. Finally, I want to speak about Coinbase and Brazil. Again, we move back into South America. We know that South America has one of the best and most relaxed crypto laws in order to attract these big companies, and it's working. Coinbase will reportedly buy the $2.2 billion Brazilian unicorn behind Mercado Bitcoin, which is a cryptocurrency exchange. This unicorn is called 2TM. It's Mercado Bitcoin's parent company. It achieved billion-dollar status or unicorn status in 2021, valued at $2.2 billion. 2TM's Mercado Bitcoin also bought Portuguese Criptoloja, which is a Lisbon-based crypto exchange in January. This shows us that Coinbase is not only putting its foot in South America by buying 2TM, but they're opening themselves up to the European market, because if they have Criptoloja in their portfolio, now they have a crypto exchange license in the European Union. And if they have that, they can easily get more licenses in the European Union. So their global acquisition strategy is snowballing, especially in South America and more specifically in Brazil. Their report stated that direct crypto trading is growing rapidly. Locally based crypto exchange Mercado Bitcoin, which they just acquired, has seen transaction volumes increase 7-fold year on year to August, which makes perfect sense because Brazil has one of the most lenient crypto laws in South America and in the world for that matter. So it's seen a lot of adoption by its citizens. Just yesterday, Brazil's second largest city, Rio de Janeiro, will accept crypto payments for certain taxes in 2023, and more than 10 million Brazilians now own cryptocurrencies, which represents around 5% of the total population. And I think this is only going to increase going forward because of all these big names coming into the Brazilian crypto industry. And I think that Brazil, it's paving its way to become South America's crypto and blockchain hub. And with that, we come to the end of today's video. Thank you very much for watching. If you liked the video, please consider leaving a like, hitting the subscribe button, and sharing the video with your family and friends. I'll see you tomorrow for the next one. invest wisely, and cheers.